Welcome to another edition of Morningstar Minute. I'm joined by Michael today. Michael, we need to start off with, of course, the Middle East. There's still a lot of geopolitical news coming out of it. What are you guys seeing?
Yeah, look, Mark, thanks. Certainly, there's just a lot of volatility day to day, and we still don't have a resolution on the conflict. Is the Strait open? Is it closed? It's very much a day-to-day proposition. So we don't have any insight on that. But I would say that the market's view is that we'd be closer to the end of a resolution than at the beginning. So they're starting to take a more optimistic view on the outlook and the ramifications. So probably it's worthwhile looking at what some of the real world impacts are going to be going forward relative to what the market is now sort of pricing in and the expectations if we move beyond the conflict.
And what are some of those things? If we look longer term, we look at some of the damage to the economy. What do you think about those ramifications?
Yeah, definitely. It's just a fact that if we've got high energy costs and if there's any continued disruption to the flows of energy globally, then there's going to be inflationary pressure across a whole swathe of things in the economy. So it impacts inflationary expectations. That's going to impact on what central banks can do in terms of their monetary policy settings. You can see that the IMF last week downgraded their global growth forecast from, I think it was around 3.3% in January. They've downgraded that to 3.1% for 2026 at their latest figure. So they've reined in those economic growth expectations for the year. Now, it's still reasonably strong growth, and there's probably a bit of downside risk if there's not a resolution to the conflict fairly soon. But you can see that there is a cost to the conflict that's going to be borne out across economies globally.
And then any good signs? So that's obviously all fairly negative, but any good signs that you're seeing?
Well, in terms of, we're going into reporting season in the US specifically, and there's some global results out there. So we had TSMC come out with their first quarter result last week, and that was very strong. So they're leveraged to the AI infrastructure play, selling sort of critical chips to that industry, and their first quarter profit was up 58%. So there's still that very strong underlying theme. That AI theme is probably less exposed to what's happening geopolitically. And so as we go into reporting season in the US, we're going to see results out of the tech stocks, and we'll get a good measure or gauge on what's happening sort of in underlying growth and demand. So potentially that's a little bit of positive news in the market. We've also saw a reasonably good GDP result out of China. So that economy's come off a weaker base over the last few years. So that was a positive number. So I do caution though, some of these numbers are backwards looking. They're sort of before the conflict of Iran. So we're yet to see some of the real impacts of those higher energy costs. And what is going to be interesting is with these first quarter reporting results is what management's outlook statements are for the remainder of the year, and if there's any guidance on a go-forward basis.
So this is a challenging time for investors. So you've talked about all these different negative signs, positive signs. There's been a lot of volatility. Do you have a message for investors and how they should react to a market like this?
Yeah, so I think our approach is fairly consistent through times like this. We've been through lots of market cycles, and it's all about staying calm, being balanced and measured, and we think the key is to maintain diversification and a consistent approach to investing, and that means that you're not reacting to the cycle and the volatility. So we think the worst thing you can do is to be panic selling at times like these. And if you have diversification in your portfolio, if you have a lot of structure around the way you're putting your portfolio together, it gives you the confidence that no matter what happens, you're gonna ride out these cycles. And then that allows you to stay invested. You're not being whipsawed around, and you can really get the benefit of that long-term compounding. So you can see in the last month or so, if you just read the news headlines and sold at peak fear in the market, you've then missed out in this relatively sharp rally and recovery in the market. And if you miss out on those rallies, then you're not going to compound your long-term returns. You're just sort of capitalizing losses short-term. So the key message is to stay calm, stay diversified, and stay very long-term to achieving your goals, and be too impacted by the short term.
Any advice in this video is general advice prepared by Morningstar without reference to your objectives, financial situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.